Well, let's get to my guest to wrap up the day. And the fourth bear market rally since the market peak in last August has seen the market go back to fully valued territory. Martin Crabb of Shaw and Partners joins us now to discuss. I guess and I did read your note. It was that comment was extracted directly from your commentary. It's all in there that you do think this is another bear market rally.
Yeah, I mean the market's still below where it was in August last year. So we're down about 5%, but it's just been a zigzag with a downward trend. And I think the issue has been that earnings have been holding up, earnings estimates have been holding up until relatively recently. They've been falling for 12 months all around the world, but in Australia, because of iron ore and our insulated economy somewhat, we haven't really seen earnings come off. That started to change in the past couple of weeks. So we started to see earnings come down, but prices have been going the other direction. So we've gone from having a market that looked cheap, because obviously lots of stocks have been downgraded but in price but not in valuation. So the market looked cheap. It's now starting to look expensive again. So after today's move, we'd probably be around a 5 or 6% TSR, which is if all the stocks in the market achieve the 12-month target prices that analysts think they should trade at. That's the black line. And you can see that the red line, which is the market, or the orange line, which is the market, has been going in the opposite direction. So that's atypical. Normally, earnings and target prices kind of rhyme together, and prices tend to follow that. But we do get these periods when the market goes the other way. So we're just getting into a serious situation in terms of global growth slowing into next year, and yet share prices are going the other way. So it's a bit odd.
Yeah, I mean, often this is just guesswork and if nothing else, fun to speculate. Do you have a theory as to why that this could be occurring at all, or is it just one of those moments where markets are doing crazy things?
Well, there's a couple of things. There's the pivot. So the central banks are done, inflation's peaked out, nothing to see here. Rates are going to stop going up shortly, and it's off to the races. We're still recovering from COVID. China's going to come out of lockdown, and it's all going to be fun and games again. Oh my God, I have no equities in my portfolio. I better do something about that. The bears have no shares, Kyle. So I think there's a bit of that, definitely a bit of that. And yeah, look, sentiment got very, very negative there for a while. If you look at things like the BAML surveys and the American Institute of Individual Investors, all those surveys of people in the market, very, very bearish. So the market was very short. So, but that's what bear markets are all about. I mean, bear markets don't go down in straight lines. Bull markets don't go up in straight lines. They get overbought, oversold. So we've gone from being a bit oversold to now overbought. The next leg of this market's probably down.
Interesting. And that, I suppose, impetus will come when we start to see that downgrade cycle in earnings?
Yeah, I think so. But you never know. You can get... So we've had... Most of the data has supported this narrative of slowing inflation. So you just get one bad print and it goes back the other way. So you've got this irony of the data's suggesting to you that maybe inflationary expectations are moderating and inflationary pressures are moderating, but all the central banks are trying to be as hawkish as they can. So they're kind of guiding people to say, look, we're not letting financial conditions loosen. We're not going to let interest rates stop going up. So I think the market's sort of ignoring that narrative at its peril. They all don't fight the Fed. Well, the Fed's telling you they're going to keep tightening and they're going to slow the economy further. And I think that's just that slow realisation that next year is going to be really, really tough.
Interesting. And I mean, when you talk risk reward as well, you spoke about, I guess, or implied perhaps that the dynamics that are occurring in bond markets, you can get safer returns perhaps at the moment in some kind of fixed income asset rather than a riskier, equity portfolio. Is that roughly the case?
Yeah, I mean, the one we're talking to clients about at the moment, just because it's interesting and intuitive, is you can get almost a 6% yield on an Apple 2060 bond. So 2060 is a long time away. They issued these bonds a few years ago at a 2.5% yield. Because of the rise in rates, the par value, or the face value, has fallen from $100 down to $60. So your $60 is going to go to 100. So you're getting that return plus the extra dividend income because the price is lower. So that's a AAA rated bond. That's a higher rating than the US government, right?
Yeah.
So that's about as safe as you can get it in terms of a bond. And that's yielding, 5% running yield plus probably another 1% yield to maturity. So that looks pretty interesting. When the TSR of the market, we just said 6%. So you can get a 6% TSR out of the Aussie share market with all the volatility and risk that goes with it, or you can buy a AAA rated corporate bond from Apple with a 2060 maturity. So it's going to be volatile, but that's giving you the same sort of return.
There you go. It seems the
There you go.
arithmetic seems to stack up, at least from a rational point of view. Let's talk Woodside, because there was a downgrade in production guidance. So what was behind that? Because they obviously delivered an update today. Obviously everyone was expecting that the numbers were going to be much better than what they had been in the past, just by virtue of the underlying oil price. But
Yeah.
I mean, what was your takeaway from those results?
It's just really production guidance. So, the broking firm we most closely follow had a probably 210, 215 million barrel estimate for their production for next year, with a mixture of sort of LNG and crude. And they came out with a guidance range of 180 to 190. So prima facie, that's 20 to 25% lower. A lot of it is to do the fact that they're commissioning quite a significant new well in Senegal, and that's potentially delayed into the following year. So that's taking a whole bunch of production out. But on the surface, the market looked at that and said, 10% production downgrade, the oil price is coming off the top anyway, I need to be out of this. The stock gapped almost 10% lower on the open. It was down a couple of bucks on the open. So that's the yearly chart there. But on the open, I think it was down $2, which was probably 6 or 7%, and it's closed almost flat. So like the market throughout the day, it's just continued to rally. So they've got an investor day on the 1st of December, so in a couple of days' time, which I'm sure they'll get into the reads. Interesting they didn't wait for that thing to come out with this production downgrade. So maybe they're putting it out in the market, then they can discuss it in a couple of days. But it's the second time that they've disappointed a little bit on production. So you kind of like it for the macro, for the exposure to energy, but at the fundamental operating level, it seems like they're pushing things out a little bit.
Interesting. And you've got one more, it's almost a fact, but it's interesting because it does speak to, well, I suppose economic activity and mobility of people, which is crunching some data about movement through the CBD and on different days of the week. What have you found?
Yeah, well, it feels like Mondays are quieter. Anyone who comes into the CBD, any CBD, will notice things are quieter on Mondays. Well, how do we measure this? So the good people of the City of Sydney have got 4 automated traffic counters, one in Bridge Street and a couple around sort of Park Street and around Myer and around there. So I just pulled the data for November to date and just looked at it. And so the yellow line is Tuesday, Wednesday and Thursday. So that's the middle part of the week. And then Monday is the red line. And then Friday is the blue line. So people are coming in on Friday afternoons, Kyle, to catch up with their mates and have a few beers after work. But on Mondays, they're just staying away. So if you look at peak hour in the morning on Mondays and Fridays, it's 40% lower than on Tuesdays, Wednesdays and Thursdays. So, that's a lot of people having the long weekend. Yeah. But then the ones on Friday, so they might not come into work, but they'll come in for the social activities afterwards. So it's really, really interesting to see it. But for people in the office market, this is a horrible chart, because if your occupancy is 40% lower in 2 days of the week, a lot of landlords will be scratching their heads saying, how do we shed some space here? We don't need it all the week. Can we move it around a bit? Can we get people to take Tuesdays, Wednesdays and Thursdays off and even it out and get rid of 20% of our office space? So that's why things like Dexus are on almost a 10% yield, because no one wants to own office.
Yeah, a few corporates that I've spoken to have sort of said that as soon as it becomes, I suppose, financially viable enough to break leases and things like that, they will. And so it might be a sort of a slow, drawn-out process, this one, I dare say.